They booked tomorrow's profits as today's income. They hid today's debts in shadow companies. In 4 sentences, a mirror image of success and fraud. The math looked brilliant. The cash told a different story. Enron was once America's 7th largest company. By the end of 2001, its collapse had wiped out $25 billion in reported assets. The accounting maneuvers leaked into headlines. An audit firm that had audited the auditors, Arthur Andersen, dissolved under the weight of what followed. This is the story of the algorithm of hubris, how a culture that worshipped intellect turned aggressive accounting into a virtue, and how that calculation failed the most basic test, actual cash flow. Start with the office. It's Houston in the 1990s, glass and granite. A trading floor hums like a machine. Young executives in suits move with purpose. They call it a new age of energy. No more pipes and poles, but information, contracts, derivatives, speed. Jeff Skilling talks about an asset-light future. Kenneth Lay talks about innovation. The company breathes up markets, derivatives, and models. The smartest people in the room build models for everything: pricing, risk, profit. That confidence becomes a currency. The accounting rule that mattered most was called mark-to-market. On paper, it makes sense. If you have a contract that will pay you a fixed stream of cash over 10 years, certain rules let you estimate the present value of those future cash flows and record them now. For a legitimate trader, mark-to-market captures real, measurable value. At Enron, mark-to-market was used as a sculpting tool. A deal announced in the morning could be carved into years of profit on the afternoon ledger. Every long-term contract could be transformed with an optimistic model and a favorable assumption into immediate income. That's where the special purpose entities enter. They're legal shells, partnerships, outside the corporate balance sheet. They can be useful to isolate risk, to finance a project. Enron's executives, led behind the scenes by Andrew Fastow, built dozens of these special entities. Some had nicknames. LJM was one, Chewco another, and the Raptors, Raptor 1, 2, 3, were dressed up as hedges. On paper, these vehicles bought assets or took on risk. In practice, many of them were the place where Enron parked bad assets and hidden liabilities. They borrowed money and used Enron stock as collateral. They bought assets that Enron quietly sold to itself. When a loss looked likely on the parent company, the loss migrated to the SPEs. When an optimistic projection could be manufactured, Enron booked it as immediate profit. What does that look like in human terms? Picture a trader who signs a contract to deliver energy over the next decade. An analyst in a glass office inputs a price curve into a spreadsheet, chooses assumptions on demand, fuel costs, counterparty reliability, and volatility. The spreadsheet shows a net present value that looks beautiful. The deal is valued at tens or hundreds of millions of dollars. The number breathes life into quarterly earnings. A bonus discussion follows. People congratulate each other. The board sees the brighter earnings. Investors see growth. The stock climbs. Enron rode that wave. From a regional pipeline company founded in the 1980s, it transformed into a trading behemoth by the late 1990s. The company built Enron Online, a pioneering electronic trading platform. It marketed itself as a utilities disruptor, an information company, a leader in energy derivatives. Analysts awarded it daring multiples. Executives strutted across conference stages. By market capitalization, Enron became America's 7th largest company. The world began to trust the numbers, but underneath the numbers, there was a comparison no one likes to do in a room full of modelers. How do the ledgers line up with the cash? Cash is stubborn. It clunks and arrives on a distinct schedule. Cash can't be assumed away with a spreadsheet. For every model that promised profits tomorrow, there had to be a reflected pattern of cash coming in eventually to match it. In Enron's case, that reflection was often missing. The algorithm of hubris fed on praise. The inputs were bright people, competitive internal rankings, and a culture that rewarded cleverness. The process was to invent complexity, justify it with sophisticated arguments, and reap the financial output: stock gains, bonuses, and accolades. The loop was simple: demonstrate intellectual superiority, get rewarded, double down on inventing ever more intricate financial engineering. What the loop failed to include was friction, practical limits, ethical breaks, skeptical questions that could be voiced without career consequences. A few people asked those questions. A memo arrived in August 2001 from Sharon Watkins, a vice president at Enron, warning Ken Lay about questionable accounting. Hers was a quiet, internal alarm that numbers might be misleading to investors. She used the word problem. It was an act of conscience in a system that often mistook confidence for truth. Investors were still not fully alarmed. The machines of praise kept whirring. Yet, seeds of doubt had been planted. Then the feedback loop shifted. A journalist began asking about the very structures that had been championed. Analysts requested clarity on the SPEs. In October 2001, the Wall Street Journal published details about Enron's use of partnerships to move liabilities off the books. The market reacted. Creditors took notice. Lender confidence, always fragile with complex derivatives, evaporated. Credit rating agencies downgraded Enron. The once shiny stock hit a slide. Executives scrambled. Here, the algorithm broke in a single decisive way. Assumptions stopped being treated as likely. Counterparties demanded collateral. The special entities that were meant to keep obligations invisible became visible precisely when market participants needed to see them. Their debts could no longer be contained. Suddenly, the cash that had been promised by models was not coming in, and the debts that had been hidden demanded repayment. In November 2001, as the company's stock cratered and liquidity dried up, Enron announced a restatement of earnings. Lawsuits soon followed. By December, the company filed for bankruptcy protection. The filing wiped out $25 billion in reported assets and left thousands of employees and investors with shattered retirement accounts. Executives who had once been celebrated for inventing a new kind of corporate brilliance were subjected to investigations that would spell the end of careers and reputations. The fallout did not stop with Enron. Arthur Andersen, the auditing firm that signed off on Enron's statements, was indicted on charges relating to document destruction. Andersen had been one of the Big Five accounting firms, a global voice in financial integrity. The indictment, coupled with the loss of client trust, led to the near collapse of the firm. Its partnership was effectively dissolved. The consequence resonated through the profession. Auditors had been partners in the ceremony of confidence, and when that ceremony was revealed as faulty, the profession itself paid a price. At each turn, the narrative threaded back to a cultural question. Why was aggressive accounting rewarded? Why did Enron's board and auditors accept structures that shifted risk instead of revealing it? Part of the answer is incentives. Compensation tied to short-term metrics, stock-based pay, and an internal culture that prized intellectual capitalism made gaming the numbers personally profitable. Another part is prestige. Clever accounting and complex financial engineering were seen as signs of genius rather than warning flags. The social currency inside the firm was reputation among peers and acolytes, not alignment with steady cash flows. This is where the term algorithm of hubris has force. Imagine a program that optimizes for accolades rather than cash. It takes inputs, bright analysts, permissive accounting rules, sophisticated legal structures, and evolves to output the highest possible earnings figure for the shortest possible time. Each success reinforces the procedure. Bonuses and prestige validate the approach. The algorithm adapts, finds new loopholes, and becomes more creative in hiding shortfalls. It does not stop until an external constraint, markets, regulators, or time, exposes the gap between paper profit and economic reality. Pause here for a moment. If you're enjoying this deep dive into how culture and numbers collided, consider subscribing so you don't miss the next investigation in this series. It helps the channel keep making episodes like this. After the bankruptcy filings, investigations peeled back layer after layer. Testimonies described a world where accounting constructs were not merely financial tools, but strategic weapons. Off-balance sheet vehicles used to manage perceptions. Internal memos that described transactions in euphemistic language. A reliance on complex valuations that few outside the inner circle could easily challenge. Former executives and employees testified about the pressure to maintain growth narratives. Regulators found that conflicts of interest were rampant. The person running some of the SPEs was also a senior Enron executive who personally benefited when those entities performed. Those revelations sparked reforms. The Sarbanes-Oxley Act of 2002 tightened corporate governance and accountability, demanding more accurate disclosures, stronger audit independence, and stricter executive certifications of financial statements. The accounting profession rewrote parts of its rulebook. Enron and Anderson became cautionary tales on university business school syllabi. Complexity lost some of its luster, yet the human tendencies behind the collapse, status, short-term incentives, belief in one's own models, remain a risk in any industry that couples brilliance with opacity. Think about what this means for the everyday investor or employee. Numbers on a quarterly report can be seductive. High growth and clever explanations are compelling. But the underlying question is simple. Can the company convert its reported earnings into actual cash? Look for cash flow statements, not just glossy projections. Ask, who benefits from complexity? Who gains if assumptions are optimistic? When structures are so complicated that only insiders can explain them fluently, that's a red flag. We also need to hear the human stories. For many Enron employees, the company was the center of life. They took pride in the culture, sent their kids to corporate events, and rolled their retirement savings into company stock. When Enron collapsed, retirement accounts evaporated and careers imploded. For communities in Houston and beyond, local philanthropic projects were curtailed. The moral accounting had real-world victims. Enron's collapse taught a brutal lesson. When markets and institutions put intellect above transparency, ordinary people can lose everything. In the final months before bankruptcy, there were scenes that capture the collision of pride and panic. Executives flew across the country to meet with bankers. Credit facilities were negotiated in rooms with crackling tension. IT teams scrambled to preserve systems. Employees, many of whom relied on internal morale and the company's brand, watched public hearings with confusion and dread. The contrast between the company's earlier swagger and its later desperation is stark. That arc, from near worship to catastrophic failure, feels less like a mystery and more like a predictable outcome when incentives reward being smart but stop rewarding prudence. So what remains after the headlines fade? Regulation changed. Corporate governance tightened. A generation of executives learned to fear creative accounting. But the algorithmic pattern, optimize for reward, hide the friction, repeat, remains a caution applicable beyond energy companies. Wherever complexity is used as a signal of intelligence, and wherever short-term gains are prized over steady performance, the potential for a repeat exists. As you listen now, consider this. The smartest room in the world is still filled with people. Models are tools, not gods. Accounting should be a mirror, not a mask. The Enron story is not only about greed or individual villainy. It's about a culture that mistook sophistication for safety and a system that let incentives outrun honesty. The algorithm of hubris is not solved with new rules alone. It's checked by a culture that values transparency more than cleverness. If you want more deep historical investigations into how finance, culture, and incentives shape outcomes, please subscribe and leave a comment with which collapse you'd like us to examine next. In the quiet after the storm, think of the trading floor that once hummed, now empty desks, a few scattered coffee cups, a whiteboard with numbers that meant everything one day and nothing the next. That image is the final accounting. It reminds us that no ledger is truthful unless it reconciles to life. The money that actually changes hands, the lives affected, the public trust that supports markets. Intelligence without humility becomes a dangerous algorithm. Intelligence with accountability can be a public good. The Enron collapse changed law, profession, and memory. It also changed how we should measure success. In the end, the company taught a simple lesson. If you book tomorrow's profits today, you will eventually have to pay for them. The question is whether anyone will still be there to foot the bill when the bill arrives.